Hello, good morning everybody. It's a real pleasure to be here. So as a colleague just mentioned, so my name is Olivier Maronneaud. I work for IHS Markit in the chemical consulting team based in London. And the kind of topic I wanted to cover today is a bit of a global overview of how we see the industry developing at the moment and what is our expectation in the short, medium term. So two key parts in my presentation this morning. One is this global overview with a relatively short, medium-term perspective, and then just wanted to cover a few key trends that we see when talking with our clients on a day-to-day basis. For those who haven't heard about IHS Markit or are just familiar with our weekly or monthly report that we publish on the chemical industry, we're a global company. We've got 15,000 employees globally, with a small office actually in Kazakhstan as well. And we cover not only the chemical industry, but we also integrated upstream into the oil and gas and refining industry, and the downstream, especially important for chemical, into like heavy industries such as automotive, aerospace and defense, and maritime and trade industries. And we've got also our own in-house economic and country risk analysis. So although we rely on global institute information, we also analyze it ourselves and use this data when doing our forecast. So I just wanted to start with the global overview of the industry, and probably one of the best ways to look at the state of the industry is to look at the earnings. So how well and how profitable is the industry doing? And this graph is actually showing the EBIT, so the earnings before interest and tax, and that's an average, a weighted average on a dollar per metric ton. So we track capacities across the chemical industry, we track production, we track demand, prices, and we have our own estimate on cost for all of single units globally. And when we aggregate this data, we come up with this estimate for earnings. And I think what the key message here is, obviously it's not a steady state industry with flat earnings, but we actually go through cycles. And if you look since the 1985, we've seen different cycles in the industry. All cycles are different in shape, different in length, different as the reason as to why the industry is doing well and why all of a sudden we come up to some kind of recession. And the objective that I wanted to cover is try to understand that into a bit more detail. The key fundamentals behind this these cycles is on one side capacity and capacity development, which is represented here as capacity surplus. So it's the development year on year of capacities versus the change in demand. And obviously the industry needs some capacity surplus. The units don't operate at 100%, but as we see more capacity surplus, that push pressure on the market. And we compare that with the annual demand growth across the industry. So we see relatively steady demand, but with some shock in some period of time. And most of the time when we had those shock in demand, that has led to capacity surplus as a consequence. And when we put that information together, so when we look at the earnings on one side and the change in capacities and demand on the other side, there's quite a clear coincidence as to why the cycles come to an end. And the main reason for that is basically most of the time a shock in demand, which is creating capacity surplus in the industry, pushing prices down, and therefore putting earnings for companies down as a result. And I'm going to go through some details and some examples. So if we look at the period from 1995 until 2004, we had relatively healthy demand, mainly driven by the boom in Asia, and especially Southeast Asia with the Asian tigers. And that has helped the industry to perform relatively well at the start of the period, until we had at once the Asian financial crisis, hitting in 98, and then following up by the dot-com bubble and the more global recessions that we've seen in 2000, 2001. And what we've seen is during that period of probably 4 to 5 years, some really difficult environment for companies, demand coming down or not growing as much as previously seen, surplus in capacities, and a relatively kind of dovish picture in terms of earnings. And quite interestingly, this is a period as well when most of the international oil and gas companies, so BP, Shell, Total, for example, divested their chemical assets, mainly around kind of that time frame. And after that period, we had the boom in China, mainly supported by the fact that China entered the WTO in 2001, and that has supported the demand in China, obviously, but also globally. The following period, so we still had that boom in China demand and global demand growth doing relatively well. That has kind of supported investment in new capacities in China to support the kind of the domestic demand, but also new capacities in the Middle East. And most of those capacities came pretty much at the time when we had the great financial crisis in 2008, 2009. And again, this crisis was relatively short in time, but we had a big drop in demand, resulting in a significant surplus in capacity and a drop in earnings. But as I said, the actual impact was relatively short because on one side we had capacity rationalization in the industry, mainly in West Europe, and we had quite a sharp recovery as well as we had fiscal stimulus both in Asia and China and in the US, for example, and then followed up by Europe. So the demand has improved, earnings has improved slightly over the following few years. And basically, since 2013, the whole industry has been performing extremely well. So the demand, although not spectacular, but has been kind of relatively healthy and steady over time. We haven't seen any big significant push in new capacities. So new capacities kind of somehow tracked new demand, and therefore earnings have improved over the last 3 to 4 years. And when you look at the whole cycle, we're now in a cycle about 6 to 7 years, and that's probably one of the longest cycles that we've seen for the last 40 years in the chemical industry. So relatively positive and bullish environment that we've been living in for the last 8 years. What about the next 5 years? So again, we track new capacity development, and we see how those new capacity is going to come on stream in the next 5 years. You would expect probably any new project expected to start up in the next 5 years would be pretty much in construction phase already. And we've got our own estimate on the demand side, and I think probably the biggest risk at the moment is really on the demand side. You can't really see it in this graph, but we have already brought our kind of demand expectation down slightly compared to our view probably 6 months or 1 year ago. I'm going to go through the main reason later on, but mainly geopolitics, macroeconomic kind of conditions which are not as positive, and a bit of a question around plastic recycling as well. So demand is kind of tracking down, nothing significant yet, nothing too worrying, but tracking down. We've seen a bit of a capacity surplus starting last year and kind of picking up in the next few years as well, and as a consequence, we do expect earnings to come down. A lot of chemical companies have reported kind of declining earnings over the last kind of 6 months, and we expect that to continue over the next few years. So we probably not to the end, at the end of the cycle, but we see definitely kind of a more difficult environment coming ahead rather than any positive news. And obviously, not the whole industry is going to behave the same way. So this is quite a similar graph looking at earnings, but with a breakdown for the key value chain, so olefins, plastic, aromatics, chlor-alkali, and syngas, so methanol mainly. And when we look at this graph, as I said, not all value chains are going to behave the same way. And just taking two examples, on one side we've got the olefins and plastic industry. And that industry has been living in, I would say, in a very perfect world for the last few years where demand has been very healthy. A lot of new projects have been announced, but some of them have been delayed, especially in the US. So overall, the environment has been relatively positive. But nowadays, as I said, we live in a kind of slightly different world with weakening economies, a lot of question around plastic recycling and the impact it could have on demand. And therefore, we do expect that the demand side is not going to be as positive. On the supply side, the project delays are now kind of coming into fruition. So we do expect some new units to be commissioned, either on the upstream olefin or downstream polyolefin side. And therefore, overall, we see kind of a bit of an oversupply situation coming up on the olefin polyolefin industry. And that is combined with, especially when you look in the US, a much tighter kind of NGL market with rising prices compared to what we've seen a few years back. So you've got higher feedstock and more difficult kind of situation downstream. So overall, we do expect the earnings, although still to remain healthy, but not to be as healthy as what it used to be over the last few years. On the other hand of the spectrum, the chlor-alkali industry has been a very difficult industry for a long time. And obviously the change that we see on the demand side is also expected to affect the chlor-alkali and PVC industry. But because the last 10 years or so in the chlor-alkali industry has been quite difficult, we haven't seen a lot more new capacities coming on stream. So overall, the new capacities and the few announcements that we have kind of keeping track of over the last few years are just about to make up with the kind of increase in demand, although demand is declining a bit. So overall, the earnings on the chlor-alkali industry has been increasing relatively well over the last few years, and we expect them to remain relatively healthy in the next few years. So really, two different trends in the industry based on which part of the value chain you're involved. So that's just the kind of brief overview I wanted to give on the industry and how we see kind of probably short, medium-term development. I now wanted to cover a bit more the kind of the key trends that we kind of track and that we kind of try to understand as well as we talk with our clients on a day-to-day basis. And probably kind of three key topics that I wanted to cover is one, mobility and the question around peak oil demand, especially for refined product. Then as a kind of logical next step, I would say is the question around crude oil to chemical technologies, and then the kind of plastic waste challenge, which has becoming more and more important. So starting with the mobility, so we've got our own automotive team, so tracking kind of this industry relatively closely, both in terms of development and growing fleet kind of on a country-by-country basis, but more importantly, looking at the trend that we see around the kind of the fleet development. And probably the two key trends that we see is on one side, the improved kind of fuel efficiency for the ICE, the internal combustion engine vehicles. And also, I mean, as you're all aware, the kind of pickup in electrical vehicle as well. And although that kind of development in electrical vehicle looks very rapid, the impact on the fleet, on the total fleet, is actually quite small, or would take quite some time to really have an impact. But the combination of those two factors is definitely putting some kind of pressure in terms of demand outlook for refined product. And this is even more important as we see kind of in the refined industry more and more investment for mega-scale refineries, and therefore kind of a lot of capex being devoted in an industry where we know that at some point we're going to see declining demand, and it's quite difficult to predict when and what would be the impact. So what we expect is a lot of, or what we see actually is a lot of refiners to be more and more interested into petrochemicals and trying to look at this market, I would say again, because some of those companies have kind of divested their assets a few decades back and see what would be their potential impact in the petrochemical industry. And the main reason for that is because petrochemicals is still expected to grow at multiples above GDP, which is not the case on the refined product, or won't be the case. So this is just a high-level graph in terms of demand for refined product and petrochemicals, both looking at obviously the importance of refined product in volume terms versus petrochemicals. But I think the key message here is the fact that at some point we do expect the demand for refined chemicals, refined products to flatten and to go down, probably in the mid-2030s, whereas we do expect chemicals to keep growing over time. Although this growth is probably sometimes put at a question mark based on global GDP development. Obviously, the kind of integration between refinery and petrochemical is not new. It's just one example in ExxonMobil in Singapore, producing kind of ethylene, propylene, and paraxylene as well. But I think the key trends that we've seen is the bigger share in chemical output from the kind of crude oil process in those units. So starting in the kind of pre-1990s, we were talking about a figure of about 15 or less % of crude oil kind of process going into petchem. And that figure has been growing to reach about 25 to 40% in some cases nowadays. And with the development of crude oil to chemical, we expect that to increase by about 70 to 80% as kind of claimed by Saudi Aramco and SABIC. So quite a significant change in the industry. So that leads obviously to the question around kind of crude oil to chemical and the development and what would be the impact for the chemical industry. Obviously, so the new technology, the main driver behind it is a decline in peak oil demand. And the question of when would that occur? So kind of putting kind of the two together is quite difficult to have a clear view on its development, but that's the key driver. One thing which is very important is the scale of those projects, and they're much bigger than any scale for kind of chemical plants nowadays. And the key impact, obviously, is the higher capex which is required to build those units. The chemical capacities, as I said, is much bigger because of the size of the units, but also because of the increasing share of chemical outputs. And therefore with significant impact potentially on the chemical markets as you see those units coming on stream. And finally, the other kind of key question is around the OPEX and how competitive those units would be. So those are still more questions than answers at this stage, I would say, but that's something we're tracking very closely. And probably the last topic I wanted to cover is plastic waste, and probably one of the most kind of discussed and more talked kind of topic nowadays, especially when you read the global news. And we've seen over the course of a year and a half, 2 years, so 18 months, 24 months, some key kind of articles and key data that has kind of raised the concern around plastic consumption and plastic waste. And these are just a few examples, but starting at the beginning of 2018, we had the BBC program, Blue Planet 2, really focusing around plastic waste in the oceans and the impact on the maritime life. Another few dates, so then, again, National Geographic put a cover around plastic waste and plastic into oceans that kind of struck their attention to the public media. Probably another key important date was November 2018, when so the Collins Dictionary quoted single-use as being the word of the year, and obviously related to single-use plastic. And then another kind of few elements. So in December 2018, there was a kind of a statistical institute in the UK saying that less than 10% of total plastic production since the 1950s has been recovered and recycled only. So, so that means that obviously the 90 remaining percent has been either landfilled or put into or burnt, but hasn't been recycled as such. So really raising some significant concern. And then that was the latest kind of key date in terms of articles around plastic waste. And kind of this awareness that is really impacting the industry, not just kind of, I would say, within the key stakeholders, but mainly within the general public, has raised a lot of concern around key stakeholders and has pushed them to react and to react relatively quickly. First one is probably governments, and governments, what they tend to do is just bring new laws and new regulation in place to try to tackle the issue around plastic waste, so reducing plastic waste and trying to push for new solutions, trying to reduce plastic consumption in some cases, or trying to promote plastic recycling. So kind of 3-4 directions for regulations to really promote plastic recycling. Associations have brought a lot more transparency in this industry and trying to kind of publish statistics around kind of what is the actual issue regarding plastic waste and what is the volumes that we're kind of talking about. And more importantly, companies are also responding, kind of putting effort together through kind of an example as the Alliance to End Plastic Waste, for example, and try to kind of think together of how to bring new initiatives to reduce plastic waste, promote recycling in some cases, and see how to tackle these issues to kind of, I would say, protect the industry from the media coverage. So at IHS, we've been looking at it very carefully, and we try to understand, again, what would be the impact. It's not very clear, but we've done some kind of analysis, doing a bottom-up approach, so really looking at the application, the polymers, and what would be the most application at risk and the impact throughout the value chain at the polymers and olefin side. So that's just a few examples, but we look at the risk of displacement, so moving away from plastic to other material, and we look at how much material, recycled material, can be consumed into those applications. And we try to map those applications, and we try then to put some kind of figures behind it and some kind of scenarios to see what would be the impact. And I think the main issues here is some plastics are already relatively well collected, sorted, and recycled. We can see that on the PET side, to some extent on PVC for certain application. But the key volumes at risk are mainly around PE and PP, which are also the key kind of polymers used globally. And obviously, when we do that, what is important to remember is that about 50% of the global petchem is driven by plastic consumption. So any impact on the plastic would have consequent impact upstream as well. This is a graph that we've just seen before. And just putting a focus on petchem, this recycling just puts some upside. They're quite limited, but still, because we can see recycled material going into new applications. But I think what the key risk is definitely some downside in terms of either recycled material kind of taking the share of virgin demand, or displacement of virgin material as well. So just to finish, key kind of takeaways or conclusion. We've been living in a very strong kind of cycle over the last 6-7 years, but overall we see this environment kind of weakening, and the economic and geopolitical risk is putting this kind of positive environment at risk. Short term, the demand growth is slowing down, and the fact that we've got new capacities coming on stream is putting pressure on prices and on earnings in the industry. Nothing too worrying or too significant, but still something to watch very carefully. And I think overall, the plastic waste challenge is very important, and again, not just important for the kind of general media, but something very important for the industry to take on and to see how to address the situation. So overall, although the environment may look relatively steady on a day-to-day basis, we do see some structural changes in the industry, and that's why we kind of try to help our client to understand the situation. And with that, happy to take any question.